How to make passive income from stocks, a beginner's guide. It may sound too good to be true, but believe it or not, there are people out there making hundreds of thousands of dollars every month from stock market investments. They do it without working long hours or taking huge risks. So how do they do it? That's what we're here to find out. We'll show you how to get started with a few simple tips, tricks and strategies so that you can make passive income from stocks without being a Wall Street wizard. Let's start. Passive income is the holy grail of personal finance. It's the dream of earning money without having to lift a finger. But how do we achieve this elusive goal? Most people think that trading or investing in the stock market is the only way to make passive income from stocks. However, there's a simpler way: dividends. Dividends are a portion of a company's earnings paid to its shareholders. You're entitled to a portion of these earnings when you own a share of the company that pays the dividends. It's like getting paid for owning a piece of the company. But what exactly is a dividend? A dividend is a payment made by a company to its shareholders, usually in the form of cash or stock. Companies typically pay dividends on a regular basis, such as quarterly or annually. Some companies even pay special dividends in addition to their regular dividends. Now, you might be wondering why companies even pay dividends. Well, there's a few reasons. First, it's a way for companies to reward their shareholders for investing in their business. And secondly, it's a way to attract new investors by showing that the company is financially stable and profitable. And finally, it's a way for companies to distribute their earnings to shareholders without reinvesting all of their profits back into the business. Now, let's talk about the right way to invest in dividend-paying companies. It's important to remember that dividends are just one piece of the puzzle. You shouldn't invest in a company solely because it pays a dividend. Instead, you should focus on the company's overall financial health and growth potential. When evaluating a company, it's important to look at factors such as revenue growth, profitability, and debt levels. You want to invest in companies that are growing and have the potential to continue growing in the future. By doing so, you increase your chances of not only receiving dividends, but also seeing shares appreciate in value. To illustrate this point, let me give you an example. Investing in a company solely because it pays a dividend is like buying a car just because it has a cup holder. Sure, the cup holder is nice to have, but it's not the only thing that matters. You want to make sure the car is reliable, safe, and meets your needs. In fact, some companies that pay high dividends may actually be in trouble. They may be using their dividend payments to attract investors and mask underlying financial issues. That's why it's important to do your research and look beyond the dividend. Now, diversification is key in making passive income from stocks through dividends. You don't want to put all your eggs into one basket and rely on a single company to provide your income. Instead, you want to invest in various companies across different industries and sectors. By diversifying your portfolio, you increase your chances of receiving dividends and seeing your investments grow over time. And as your portfolio grows, so does your potential for passive income. Let me give you an example. Imagine you have a portfolio of 10 dividend-paying stocks, each with an average yield of 3%. If you invested $10,000 into each stock, that would give you a total investment of $100,000. Assuming all the companies continue to pay their dividends and you reinvest them, your passive income would grow over time. Now let's talk about the potential pitfalls of dividend investing. While dividends can be a great way to generate passive income from stocks, they can also be a trap. Some companies may offer high dividend yields to attract investors, even if they don't have the financial health to sustain those payouts. This can lead to a situation where the company cuts its dividend, causing the stock price to plummet and leaving investors with significant losses. That's why it's important to do your research and look beyond the dividend yield. To understand dividends and their significance, it's important to know who the actual owners of the company are. While many people assume that the owner is the promoter or the director of the company, the truth is that the actual owners are the shareholders. Think of it this way: when you buy a share of a company, you're essentially buying a piece of that company, and the more shares you own, the more ownership you have in that company. So, if you're a shareholder, you're entitled to a portion of the company's earnings as dividends. And while some companies may pay out more in dividends than others, the fact remains that as a shareholder, you have a stake in the company's success. To put it another way, think of a company like a pizza. The owner may have created the pizza, but the shareholders are the ones who get to enjoy a slice slice of the pie. And just like with a pizza, the more slices you own, the more of the pie you get to enjoy. The story of Apple is a great example of the power of shareholders. When Steve Jobs was thrown out of the company he started, it was the shareholders who held the power to make that decision. And that's not all. As a shareholder, you also have a say in the company's decision making. Many companies offer e-voting options to shareholders, allowing them to participate in key decisions and make their voices heard. So if you're looking to make passive income from stocks through dividends, remember that you're not just investing in a company, you're becoming a part owner of that company. And with that ownership comes both the potential for rewards and the possibility to make informed decisions. Now that we understand who the real owners of a company are and how dividends work, let's dive deeper into how dividends are actually paid out. When a company earns a profit, it's required to pay corporate tax on that income. Once the tax is paid, the remaining profit can be distributed to shareholders as dividends. For example, let's say a company earns a profit of $10 million. After paying corporate tax and surcharge, they're left with $7.5 million. If the company decides to pay out dividends, they can use this $7.5 million to do so. As explained earlier, companies pay dividends to their shareholders from their profits after paying taxes. Dividends are not fixed and depend on the company's decisions and profits. Some companies pay dividends 3 to 5 times a year, while others pay them once a year. It's essential to note that the dividend percentage is calculated on the face value of the share and not the market price. Many people get confused and think that if a company is giving a 200% dividend, they will earn twice the amount of their investment. However, that's not the case. For instance, if the face value of a share is $10, a 200% dividend will give you $20 per share. That's it. Let me break it down for you. The face value of a share is the initial value of the share when the company issued it. It's usually a small amount like $30 or $300. So when a company declares a dividend of 100% on the face value of the share, it means that they are paying a dividend equal to the face value of the share. For example, if the face value of a share is $30 and the company declares a dividend of 100%, then it will pay a dividend of $30 per share. But if the market price of the share is $300, then the dividend yield is only 10%. So the next time you hear about a company giving a high percentage of dividends, don't jump to conclusions. Check the face value of the share and do the math to calculate the actual dividend yield. For instance, a company may offer an attractive dividend yield of 15.24%, but a closer look at its past performance and financials reveals a negative return of 40.19% over the past 5 years and a debt of $7 billion. While the company may be giving dividends in the thousands of millions, it is not reducing its loans, which is not a good sign. It's crucial to understand the concept of X date, which is the date set by a company for determining the shareholders eligible for receiving a dividend. If you own shares before the X date, you're entitled to the dividend, but it's important to remember that high dividends alone do not make a company a good investment. You must analyze the company's overall performance and financials to make an informed decision. Let me give you one more example to make it crystal clear. Imagine investing in a company called XYZ Limited with a share price of $50 and a dividend yield of 5%, which means you will get $2.5 per share as a dividend every year. Let's say you invest $50,000 in this company, which means you own 1,000 shares. In the first year, you will get $2,500 as a dividend, which is not bad, right? But that's not all. Let's assume that the share price of XYZ Limited increases to $100 after 10 years, which is a reasonable expectation if the company's doing well. Your investment of $50,000 will now be worth $1 million and you will still be getting $5,000 as a dividend every year. And the best part is, you don't have to do anything to earn this income. It's passive income, which means it comes in whether you work or not. To find out if a company is worth investing in, you should not only focus on the dividend yield, but also consider its future prospects. A good company's share price will appreciate over time, and it will offer consistent dividends. Thus, the two ways to earn passive income from stocks are asset appreciation and dividends. Let's take the example of any company which has been a favorite stock for many investors. Suppose the company has given more than 40% returns in the last few years and offers a dividend yield of 3.94%. While the dividend yield is considered good, it is crucial to remember that whenever a company gives dividends, the value of the company decreases. Suppose a company has a total value of $10,000 million and it gives this out 2,000 million as dividends. In that case, the remaining value of the company becomes 8,000 million. This decrease in the value of the company affects the share price, resulting in a slight correction. While some good companies recover their prices, the effect of the dividend payments on share prices is significant. Now, there is one calculation left. Let me explain this calculation with one example to make it easier for you to understand. Suppose you invest $2,000 in a company that gives a dividend of 4%. In the first year, you will get a dividend of $80, which may seem small, but over the years, as your investment grows and the company's profits increase, your dividend income will also grow. If the company continues to give a dividend of 4%, you will get a dividend of $160 after 10 years. So, as you can see, even a small dividend percentage can lead to significant passive income over the years. The key is to invest in good companies and hold on to your investments for the long term. I hope this beginner's guide on how to make passive income from stocks was helpful to you. Remember, investing in the stock market requires patience, research, and a long-term perspective. If you have any questions or want to share your own experiences, please leave a comment below. What other topics would you like us to cover in our future videos? We would love to hear your thoughts. Goodbye!